Hi everybody, Dean Anson here from Kernel. Really pleased to be joined by Tim Edwards from S&P Dow Jones Indices today. How are you, Tim?
Hi Dean, I'm good, thanks, and it's a pleasure to be joining you.
Yeah, look, so obviously we're having a general conversation, so 10, 15 minutes to touch on index investing, the rise of indexing. So first of all, do you want to give a little bit of an intro as to yourself and S&P and the role within investments globally?
Sure, so my name is Tim Edwards, and for the past nearly 10 years, I've worked for a company called S&P Dow Jones Indices. What we do is, at our simplest level, is we measure markets. So we work sometimes with exchanges, sometimes just on our own to build indices that capture the performance of a whole stock market, bond market. This includes indices like the world's first stock index, the Dow Jones or the Dow Jones Industrial Average. But we've also partnered with exchanges around the world to produce indices like the S&P ASX 200 for Australia and the S&P NZX 50 for New Zealand.
Yeah, and I thought obviously many investors, for us, we're familiar that Kernel's role obviously as an index fund manager is to effectively work with providers like yourselves where we will track a specific index to give investors the benefit of a fund structure that tracks one of those well-known indices such as S&P 500. Maybe just want to talk a little bit about the growth that we've seen over the last sort of 10, 20 years towards indexing and what some of those drivers have been as to why so many investors are moving into index tracking funds.
Yeah, sure. I mean, it's actually a story that reaches back around 5 decades. So the very first index fund was created in the early 1970s. And the idea there was the same as it is now. Rather than trying to beat the market, why don't we just track the market? It was a revolutionary idea at its time, much mocked in its early days. You know, people said, "Why would you settle for average?" But over the years, the decades, what the data showed was that, first of all, an index tracking investment is not necessarily settling for average. And I'll explain why that is. But I think more importantly, it's the power of diversification and transparency. So rather than needing to select or carefully choose someone who's going to make the right decisions for you, you just participate in the whole market. And you have, all the different companies involved in a proportion weighted, basically companies with more ability to take your capital, get a bit more capital. It's just a clearer and simpler way of participating in markets that ensures you capture the gains that can be achieved over the very long term from an equity investment.
And part of the big drivers in this shift, which we're seeing, from the 1970s in the US, we've had sort of our first sort of index tracking products here since the mid-90s, and seen a growth subsequently to that. Some of the big drivers that obviously have been, I guess, the data that's coming out from groups like S&P with the publication of the SPIVA report. Do you want to touch a bit on the insights from SPIVA?
Yeah, absolutely. The data that I was talking about is included in something called our SPIVA reports. So SPIVA stands for S&P Index versus Active, and the idea is what we do is on a regular basis, we will look at actively managed funds, so stock pickers essentially. And we'll look at the whole universe that was available, what was out there, and then we'll put each fund into the right category. So if it's an Australian equity fund, it goes in the Australian equity category. If it's a growth fund, we've got a category for that. And then over various time horizons, could be as short as a year, or could be as long as 15 years, we'll look at the proportion of those actively managed funds that did actually beat the appropriate benchmark. So in the case of US equity funds, how many beat the S&P 500? What that data shows is, first of all, in the short term, over a month or two, you'll get, roughly half ahead, roughly half behind, which you might expect. Over the long term, a very different picture emerges. And in the US, for example, if you go over 15 years, it's actually the case that 9 out of 10 US actively managed funds underperformed the S&P 500. And that number isn't unusual. We've seen similar statistics in geographies around the world, including Australia, Europe, etc. So what the data shows is, and this is why I sort of say an index fund is not necessarily settling for average, because if the index fund can match the performance of the index, over the long term, the data shows that's actually doing better than the vast majority of actively managed funds.
And I think all this research is compounding. What we're seeing now is more investors are becoming aware of this. Time has obviously played out to show the consistency of this over vast periods of time now across multiple markets and market environments as well. And we're seeing that shift in awareness, and particularly even within Australasia now, we're seeing that growth and awareness of investors actually going, okay, we may be a few years behind where the US has got to on this, but a lot more people are understanding now of the value from picking index funds or being involved with index funds rather than trying to pick stocks, the benefit of the diversification. Obviously, one of those big drivers as to why active has, I guess, a bit of a hurdle to overcome initially is the cost difference, right? So obviously, index funds like what Kernel operates, where it's systematic, it's about giving investors the market return for a cost-effective, lower cost than what you could probably do in terms of doing that yourself, even with picking stocks. And that fee difference between actively managed funds and indexing can be quite significant. I think you guys have recently published or updated some of the data of what you've seen out of the US.
Yeah, so we, I mean, it's an interesting statistic, and I'd like to put it in a bit of context, if I may. But first, I'll tell you what exactly we calculated. So we looked at just a few popular indices. So the S&P 500 was one of them, and then we also include our index for medium-sized and small US equities. So the S&P 400 is the medium-sized one, and then so 600 of small-cap stocks. And we've actually kept track over the decades of how much capital has been invested in index funds tracking those indices and what the fees have been. And typically, the fees on index funds are much lower for various reasons that we can perhaps go into, but they are much lower. And what we looked at was compared to, at the time, what was the average fee charged by an actively managed fund in the US equity category. Then year on year, we could calculate what the savings that had been achieved by investors if they were holding index funds instead of actively managed funds, and add that up year on year on year. And we did this, the study stretched back to 1996, so we've got a good period of time there. And the total savings that we estimate index funds just on those indices have helped to save investors compared to actively managed funds is a grand total of $403 billion US. So I'd like to put that in a bit of context. It is a huge number. So back in 1947, I think it was, there was a book published by, it's a real Wall Street classic. It's called Where Are All the Customers' Yachts? I highly recommend it. It's by a chap called Fred Schwed. And what he did all the way back 70 years or so ago was talk about how on Wall Street, there were lots of investors coming in and betting or making trades. But the people who seemed to be getting really rich were the people servicing those investors, hence where are all the customers' yachts. So I was thinking about this and that figure. So there are, according to the internet, there are roughly 10,000 luxury yachts in the world. There's an average price of $5 million per yacht. So that aggregate statistic of $403 billion in saving is enough to buy every luxury yacht in the world 8 times over. So it's a material number indeed.
That is significant. And I think, that's partly what's driven this big debate on active versus passive and what will hold out and how should people invest. We've actually run similar numbers here. So obviously, New Zealand, for context, is relatively small compared to even those numbers. You know, the size of our entire stock market is only about sort of $160 billion. So you could also buy the New Zealand Stock Exchange a couple of times over with those savings. But equally, what we have here is our retirement savings account, which is sort of KiwiSaver, and that is now $100 billion worth of assets. When we've looked at the numbers in New Zealand, similar sort of story where we're forecast to pay in fees over $15 billion in fees on KiwiSaver over the next decade. Investors who would shift out of the average fund into a lower cost sort of strategy would look to save, if 10% of the market shifted, would save about $1 billion. So we're seeing similar sort of stories coming through here now where, you know, the average fee collection on KiwiSaver in New Zealand is nearly $700 million a year in little New Zealand in terms of fees being paid. And so I think the awareness now of the impact of those fees, particularly when you compound it over a long period of time. And, you know, time is key to a lot of these conversations, right? To, you know, the stats around 9 out of 10 outperforming, it is all coming down to time. And for most investors, often they are investing for a very long period of time. They'll be investing through retirement accounts or KiwiSaver where they are taking a view of 10, 15, 20 years. And I think we're getting far more awareness now of the value of indexing and its role within those sort of investment strategies. I guess,
so if I may, just to emphasize the point you made about compounding, right? I mean, I talked about this long-term study. I mean, for many market participants, for investors, 1% doesn't sound like a lot. You know, it doesn't. 1% it's just 1%. It doesn't sound like a lot of money. The thing is, if you pay 1% on your investment every year, after 2 years, it's 2%. After 3 years, it's 3%. And if you're going to stay invested for 20 or 30 or 40 years, all of a sudden you're giving away a very high proportion of your investment just in fees. So it really is, the difference is over the long term that it becomes so much more powerful. And I think that's one of the reasons why, you know, our SPIVA statistics become very, very powerful over longer term horizons.
And for those that are watching, what we'll do is we'll put up a link to that SPIVA website, because I actually think the website that you guys have is a fantastic tool, because there's a great infographic where people can drill down into countries. We don't yet have it available for New Zealand, but hopefully soon enough over time, that sort of information. A small market obviously here, but as you've sort of highlighted, the data is broadly consistent, and we see these sort of general trends across most markets globally. I guess obviously we've seen this big shift towards indexing over the past sort of few decades within the US. We're seeing that now across Australia and New Zealand. What do you see next in terms of the evolution of indices? Because obviously we've gone from just having access to very common things that people are aware of, the S&P 500, the S&P NZX 50, those sort of, where do we see the next sort of shift within indexing and what's coming up?
So I think there's two things probably worth highlighting. The first is the evolution of index funds. So we will always have, and there'll always be, a really important place for just pure market access. But what's happened over the years is different kinds of investment strategies have been, if you like, indicized, and indices have been built for them. These include things like if you're looking for income from your equities, i.e. higher dividend paying stocks. That's something you can build an index for. At the moment, there's a lot of innovation and development around the notion of incorporating values into your investment, like, for example, a wish to be climate aware or even proactively supporting companies that are, you know, on a better path to transitioning in their energy usage. So there's other ways in which index funds are evolving to meet different needs and different kinds of investments. And then in the background, although indexing and index funds have been a fantastic sort of 50-year success story, it's worth reminding ourselves that the vast majority of invested capital is invested in a very active way. Index funds are still much smaller than everything else. And every time historically that we've gone through one of these downturns or market crises, the tech bubble of 2000, the financial crisis of 2008, the COVID crisis of 2020, and the rough high volatility, challenging markets that we've seen in 2022, what tends to happen in each of those occasions is, in the aftermath, investors sort of take a look and say, okay, what do I want going forward? Because I've been disappointed with what I was doing. In every previous downturn, we've seen investors take the decision, what I really want is better transparency, more clarity, more simplicity, and more diversification. And so each time we've gone through this, it's added an impetus to the interest in the solutions that index-based funds can provide.
We're seeing that already here, I think, in terms of even Kernel's own growth and sort of the engagement we're seeing and commentary from our investors. Last few years, there's been a lot more just general engagement around investing in shares. And that did lead a lot of people to start trading stocks. But I think almost what we've seen is now a bit of a reset and people going exactly to your point, okay, maybe that's not how I'm going to manage my money going forward. And actually, how do I get good diversification? And focus back for us, what we're seeing a lot more investors focusing back onto what their long-term goals are and the habits and that they need to get towards those. So the regular investing, using index funds for diversification, those sort of things I think are coming back to top of mind. I guess for context on that as well, a really interesting statistic that we found is, so we have a direct to retail platform, and through that, our investors, 9.5 out of 10 trades are for a buy. So, and that's been really consistent actually throughout the year, despite the market downturn, despite some of the corrections, we've not seen it fall below 8.5. So a really high percentage of people are just using the funds as, I guess, that long-term mindset and habits and looking for transparency. And I think your comments are very true around these waves, I think, do trigger people to come more engaged, but also to reset their thinking and understand, okay, how am I going to invest going forward?
Yeah. I mean, look, if your responsibility of what you're trying to do is to pick the best stock or the best funds that's going to do really well, it's a short-term mentality, because at some times, after a while, that won't be the best stock. It'll increase in price, and the next opportunity will be somewhere else. So the very notion of actively managing stock picking, it's short-term. The notion of index fund investing, by its very nature, is more about seeking long-term performance, long-term solution. And I think that's something that can help investors to stay the course. Our best instincts tend to work against us. What we want to do is we want to sell when everything's gone down. We want to run away when things get spicy. And actually, that's, at least historically, that's not been a helpful strategy. The best thing to do in terms of generating long-term outcomes is to be patient and to ride out the storm.
Perfect. I think that's a great spot to leave it, Tim. Really appreciate your time today, and thanks for joining us here.
Thanks for having me. Cheers.